The big crash is coming. Everything is going to zero. We are in a bubble in crypto. We are in a bubble in AI and tech stocks. We should sell everything now and buy gold and silver. Now that's what the fearmongers of this world tell us. People like Peter Schiff, or like Michael Burry, or like Mark Faber, right? Professor Boom, Doom and Gloom. They always say that the crash is going to come. And of course, most of the time they are wrong. But at one point when they are actually right, then they are highly celebrated. And so I do like that people are making fun of this. This is Peter Schiff, aging over the decades, gold staying at $1,700, while Bitcoin went from $1 to 10,000 to then in the end $1 million. But there are numbers that made me worried, and I looked at the data in a bit more detail. There was a post here in the public Telegram channel of Bitcoin Strategy. If you want to join, the link is down below. And in this message written by Kreda, he shared a tweet. At the height of the dot-com bubble, Cisco was worth 5.5% of US GDP. Today, Nvidia market cap is worth 11.7% of GDP, over 200% higher. And so here are the GDP adjusted charts. Cisco was the most expensive of the stocks at the peak of the dot-com bubble. And so this is the Cisco price over time. It seems like even if you bought the peak, it's not really that much of a problem. We'd only be down by 35% compared to that peak. But the issue is, of course, opportunity cost. From top to bottom, we've seen a crash of more than 85%. And if you look at Cisco relative to the Nasdaq 100 since that peak, we've seen an underperformance of similar magnitude, minus 88%. And so that's the problem with US dollar charts, right? The money supply is expanding over time, and so pretty much any asset over time gets bailed out because the US dollar devalues over time. But we can have a look at relative valuations. What we have here behind me is the Nasdaq 100 relative to the S&P 500. So we take away the effect of monetary expansion 100%, because monetary expansion has impact on both tech stocks and regular stocks. And what we see over here is the dot-com bubble. When the dot-com bubble burst, the Nasdaq 100 underperformed regular stocks by 69%. Less than what Cisco underperformed, but still quite impressive. Now we are at similar relative valuations again. And so let's look at what Nvidia has been doing. This is the Nvidia chart. By the way, all the charts we are looking at are logarithmic. If we don't look at them in a logarithmic way, this is what we get. And we see our dot-com bubble here as well. Nvidia crashed during the time also by more than 80%. It recovered faster. And since 2015, where we initially rallied because of crypto mining and then subsequently because of AI, Nvidia appreciated by more than 5,000%. You put in $10,000, you get $500,000 back in less than 10 years. I have a look at this. This is Nvidia relative to Bitcoin. Nvidia was able to grow as quickly as Bitcoin since April of 2013. So if in April of 2013, so it would have made zero difference if you bought Bitcoin at around $100 or if you bought Nvidia stock in the first quarter of 2013. Both assets performed similarly. Now there's something that's not fair comparing a company's market cap relative to the GDP, because the market cap of all of stocks relative to GDP increased a lot. And that's potentially another reason to be worried. This is the Buffett indicator. This looks at the market cap of the S&P 500 relative to GDP. And that market cap was at around 130% of GDP during the dot-com bubble. Then we had the dot-com bubble burst. Then we had our global financial crisis with the subsequent recovery. We also had a COVID crash along the way. But now the S&P 500 is almost 2 times the annual GDP of the US. The big question is whether or not this is justified. The big question is whether or not this can hold. Are US companies simply just more international now, and do they simply just make their money much more offshore? And thus comparing the market cap of something that's inherently international to something that's geographically limited is not necessarily fair. Should this actually over time rise and rise further as US companies expand more and more globally? But then on the other hand, we didn't see that ratio rising during the 1970s and 1980s. And this was where a lot of globalization actually happened. And so I find this number rather worrying. But instead of comparing to the GDP, what we can also do is we can compare the market cap of Cisco and of Nvidia relative to the money supply at the time. So Nvidia has currently a market cap of 2.92 trillion. Cisco had a market cap of 546 billion at the peak of the dot-com bubble. So here we've got the money supply over time. We're currently at a bit over 21 trillion. And in the first quarter of the year 2000, we were at roughly 4.6 billion. So I've run the numbers. Right now, Nvidia is 14% of all of US M2. And in the year 2000, Cisco was 12% of all of money supply. So again, very worrying. This needs to go to 1 million or March buyers now will make millions. This is how you get the clicks on YouTube, but this is not how you beat the market. To beat the market in crypto, you need to be better informed than the rest. You need to be better skilled than the rest. You need to do better blockchain analytics. You need to track other people's wallets and know what is the smart money doing. It's the boring educational content that forms skill that doesn't perform so well on YouTube though. That's why I created the premium membership. Feel free to check it out. We are tracking influencer wallets to find out what they are buying before promoting this on YouTube. We've got a lot of tutorials to help with on-chain analytics, to help with wallet discovery. And of course, there are also plenty of chats where we help each other and also one-on-one conversations with me. So I'm messaging every premium member one-on-one directly. Once you're joining, you will get a message from me and you have the opportunity to directly pick my brain. Feel free to check it out. thebitcointrader.com, link is down below. People say that there's something fundamental behind Nvidia's rally. Of course, there's a lot of demand for the AI chips, but the question is, at the time, Cisco was also a highly profitable company. I'm not doubting that Nvidia has value, but the question is it as valuable as 14% of all of the dollars floating? Is this a rational number? Now let's play devil's advocate and let's say, yes, this is justified. It should be at 14%. In that case, Nvidia stock would only appreciate by 6.8% per annum going forward, right? If this ratio stays, because US money supply expands by only 6.8%. Now, is it worth it to hold something as risky and as volatile as Nvidia to just get 6.8%? Probably not. The reason to buy something risky is to get outperformance. In other words, when we are buying Nvidia now and we expect it to grow faster, then that implies that it should be even more of global money supply that should be soaked up in Nvidia's valuation. So you're betting on this number to go up further, to go maybe to 20%, to go maybe to 28%, if you want to get more than those 6.8% money supply growth. I don't want to be a party pooper and I don't want to be compared to the alarmists that I just started this video off with. I don't talk about crashes all the time and I don't pretend to be able to time the top perfectly. But some numbers are simply worrying. Tech stocks have never been as expensive relative to all other stocks. And stocks in general have never been as expensive relative to the US production capacity. And the most hyped stock has never been as expensive relative to US money supply ever. And by the way, Bitcoin never lived through a serious crisis. Bitcoin was born out of the global financial crisis. So it exists since here, during a time when the S&P 500 market cap relative to US GDP more than tripled. I don't dare to predict what's going to happen, but I do think it does make sense to have some gold, have some silver, have some things that are risk off. It doesn't have to be the majority of a portfolio, and we don't have to go 100% X levered short on Nvidia, but just have a look at those macro cycles, right? This is gold relative to the S&P 500. So again, we take away the effect of monetary expansion because that has an impact on both gold and the S&P 500. This is just relative valuations. We had gold rallying massively after the Nixon shock. So after the US dollar couldn't get directly converted into gold anymore, that's where people wanted hard money. Then the tech boom came and gold underperformed stocks massively. Then the dot-com bubble burst and gold outperformed. And in the last 13 years, gold tended to underperform again. By the way, those swings are very, very large. Gold relative to the S&P 500 underperformed in the 80s and 90s by 97%. And so I think it's simply reasonable based on the data to have some money stashed away. If you're very cautious, 20, 30, 40%. If you're not that cautious, if you still want to go risk on, then at least 5% in something like gold or silver, I believe makes sense. If you've got 5% in gold and that then outperforms by 800%, then those 5% turn into 45% and you survive that crash quite well. Again, it's simply about being rational, right? Having 5% of your portfolio in an additional risk on bet like Nvidia, or having this somewhat lowly correlated in an asset class that's going to potentially appreciate during a time, I think will not make that much of an expected return difference. But it does make a difference in terms of volatility, and it does protect an overall portfolio quite a lot. If you got something out of this video, please help this channel grow by giving this a like. Feel free to also subscribe, of course, in case it's your very first time here. Again, in case you've got Telegram and you've got interesting data to share, data that we could discuss in another video, feel free to join us. The link to the channel is down below. Looking very much forward to chatting with you.